Thank you, Kathy. I hate introductions like that. She's a brilliant speaker, and now I'm just going to go blah, blah, blah. Anyway, look, I've just joined sort of for 40 minutes of that discussion, and I almost feel like I'm in the wrong place here, because I could imagine that conversation could have gone on for another hour or so. And it's important to all of you because it's about your career and how you're going to progress and so on. And interestingly, I'm in a male-dominated industry as well, and so start me on diversity and honestly, the issues that you were talking about, they're just as relevant. In fact, it's even worse, I think, in financial services, because for a start, you would never get a room of this many women who work in fund management or in the investment area, and if you did, the majority of them would sadly be client services people or comms people, marketing people, rather than the actual decision makers, the people who handle money and who make the decisions on behalf of investors. So, it's wonderful that there are so many of you here, but the issues, prevail in my industry as well for what it's worth. So I'm obviously not going to be talking law. I am going to be talking finances, and I guess the relevance to you is that, law and financial services are not miles apart. We are all professionals, and if you're successful in your careers, then you're going to have money to spend and invest. And look, if I can make a little bit of difference from what I talked to you about today in terms of what you do with your money, then hopefully you can have two-pronged success. You can have success in your career and financial success, because too few women actually achieve financial success. And there are a whole lot of reasons for it, and it's not something that can be fixed overnight. But I've been working in financial services for 30 years, and I've seen the same things, same trends repeat year after year after year, and it's really hard for women to just achieve financial success. And so anything I can pass on in terms of the experiences that I've had and lessons I've learned, hopefully it might resonate with some of you. So, look, from grad to grade, well, first of all, talking about what is financial freedom. And look, for me, I don't have a number on it. For me, financial freedom means the freedom to spend your money and spend your time the way you want to. And so for different people, that will mean different things. For some people, financial freedom will be being mortgage-free, and that will be sufficient. For others, it will be having a better retirement lifestyle than their girlfriends, because we are all naturally competitive. It will range, but whatever. For me, financial freedom means just having the freedom, the flexibility to be able to make choices. I am financially free. I think I'm financially successful as well as professionally successful, and so that gives me the right, I think, to lecture you for the next 30 minutes or so. So, first, disclaimer, can't be in a legal room without a disclaimer. So look, financial freedom is possible for all of us, but there are undoubtedly some roadblocks, and some of them are genetic, some of them we put there ourselves, but it is possible. We have to get over these roadblocks. I've met countless women over the years, clients and colleagues, potential colleagues, and there are some commonalities amongst us all that we have to overcome if we're going to be successful. I thought before I start, I'm just going to tell you my story briefly on how I achieved financial freedom and financial success. And look, I tell you what, if you got any other male fund manager standing in front of you and telling you his story, I guarantee he'd have a different slide than mine. He'd say, I'm just a clever investment decision maker. I picked a whole lot of stocks. I made a lot of money for my clients. I made millions, and therefore I'm financially successful. Whereas my story is slightly different, and I start off with personal because each of these personal elements, my parents, my husband and my daughters, have been absolutely pivotal in my achieving financial success and professional success. I was an average student. I'm not particularly academic. I hate maths, which is interesting, I think, for a lot of people. They think, how can you be managing money when you hate maths? Well, you employ other people who are really good at maths, and they can do that sort of thing for you. And you rely on the things that you're really good at, like your gut feeling, your instinct, your ability to talk to chief executives and find out the story behind a company that's going to make it a successful investment. And you do that, but you surround yourself with people to give you the other skills instead. So look, my parents, I have to talk about them really, because I think I'm successful today because of the values and the motivation that came from my parents. My parents always they wanted they wanted to be high achievers, both of them, and neither of them achieved quite what they wanted to achieve, and so they sort of pushed it onto me, really. I was the eldest daughter, and so I was expected to achieve. So it was always just a given that I had to do a degree. My father had been an accountant, so it was a given that I should do accounting, even though, as it turns out, I wasn't great at accounting. But that motivation, those values, I think, helped me in the early years, where I encountered all the same prejudices and difficulties and roadblocks that women today experience. My parents both died when I was relatively young. My father died when I was 13. My mother died when I was 30. And so, but the values and the motivation that they instilled in me remained. Hugh, I have to mention him because in 2 weeks' time we will have been married for 30 years, and so he's been a fixture in my life, and I've been a fixture in his. And he supported me when I started Fisher Funds. He was, from the outset, I was the primary earner, and it was my career that was going to enable us to achieve our financial goals. And so that has helped. Not all women have supportive partners, and not all of them need supportive partners, but for my story, it has been quite pivotal. And my daughters, Devon is my eldest, she's 18, and I launched Fisher Funds after I had Devon because I couldn't be working in a corporate environment. I felt I couldn't be working in a corporate environment, managing a team of 12 and managing hundreds of millions of dollars, and also be a good mother. So I left the firm. I started up Fisher Funds. I started it from home in our front room. Hugh joined me 3 months later, and so I was able to be a mother at home because Devon was just down the hall with a nanny, and also run my business. So it was ideal, and I think because it worked for me in terms of balance and all the boxes were ticked, then I think Fisher Funds was able to be successful. In terms of professional, the professional story is pretty straightforward, actually. An accounting degree, which I never really relied on once I graduated. That was sort of the end of the accounting, and I went to work in share broking here in Wellington, and this was in 1984, just before the 1987 crash. So I had 3 years of raging bull market where you could buy anything and make money, and I did on behalf of clients. So I thought I was a bit of a hero at sort of 23 years old. I thought there was nothing that could stop me. My first bonus was $20,000. At the time, Hugh was earning $18,000. So I went and bought a Mazda RX-7, full body skirt. Anyway, great start to a career. Then came the 87 crash, and I learned all the lessons that came with, clients losing half of their money overnight, literally overnight, and then it taking 5 years to recover that. And you've got to still hold your hand and try and add value to clients, even though you haven't done it, the markets have done it. But even so, it was a really steep learning curve. And then, as I say, I went solo and have never looked back. So today we have Fisher Funds, and look, I'm very, very proud of Fisher Funds. We're the fifth largest KiwiSaver provider, the largest New Zealand-owned KiwiSaver provider. $6.5 billion, starting from, in 1998 when I started Fisher Funds, we were managing 17 million. So to have nearly 7 billion now with 250,000 clients, a team of 58, look, I feel really, really proud of what we've done. And importantly, I've got work-life balance. I'm actually a happy camper. And yeah, look, I think we've had success. So that's me. Now, talking about women and finances, look, as I say, over 30 years of working, I know that women have unique issues when it comes to money. And I think it's important to handle them head on. First of all, we earn less than men, and we can debate this for as long as we like about how we should be, it should be equal pay and all the rest of it. But for the foreseeable future, we will earn less than men. We spend less time working. We live longer, on average 7 years, and so we're going to run out of money sooner. So we have unique issues, and we need to have unique solutions to solve them. Our brains are actually different. We are wired differently. And I sort of always knew from my interaction with women that we think differently, but I was interested to come across this sort of scientific fact that we are actually, like our brains are different, and so we do think differently. So in a woman's brain, the anterior cortex is larger than in men, and this is the area of the brain which is in charge of worrying. And this is why we are naturally more risk-averse as investors. So we worry more, we've got more to worry about, and our brains just spend more time worrying than men. That's just something that comes to us naturally. We've got to learn to overcome that. The insula processes gut feelings, and it's larger and more active in women than it is in men. So things have to feel right for us before we can act. So being presented with logical facts and figures isn't enough for a woman. For a man, it will be, but we've got to understand it logically, but then we've also got to feel right about it as well. And so that means that we take longer to make decisions. And so that can help us as investors, but it can also hinder us. And the hippocampus, which is also more active and larger in women, stores our memories. So if we've experienced loss or risk or been scared in the past, or we've made a poor money decision, then it stays with us. We remember it more, and so therefore we try and do anything we can to avoid it happening again in the future. So now, while a woman's approach to investing may differ from a man's, it's not necessarily a bad thing. In fact, research tells us that women have a distinct advantage over men because of these differences. So if you look at these traits, these are actually traits which lead to being a successful investor. So we trade less, we have more self-control, and we don't like to take risk because our brains are wired that way. We have a realistic way of looking at life. We're not half full, half empty. We research more. We typically ask questions more. Women I've met over the years want to ask lots and lots of questions, and they want to talk to as many people as they possibly can before actually making an investment decision. Whereas men think that they are genetically predisposed to being great investors, so they just go out and invest. Sorry. We resist peer pressure, which is a good thing. We think for ourselves. And we learn from our mistakes, and we do opt for safer investments. Now, on the flip side of some of these things, it can detract from us being successful investors, but they're also traits that can lead to us being very successful. So why aren't we? Now, these statistics are actually from the US, but I suspect that Kiwi women are similarly the same. We are just often not as prepared. We've got the brain power, we've got all the traits that are required, but over the years I've made some observations that about other roadblocks and obstacles that women might face. Now, in terms of preparedness, I guess the starting point for being a successful investor is being prepared to learn a little bit, to find a little bit of information. I mean, if you're going to buy a fridge, you'd go out and research fridges. At least you do some basic research. Whereas women often just are not even prepared to devote any time at all to researching investments. It's like, well, I've got some money, I'll just stick it in the bank and I'll leave it there because I don't have to worry about it, and I don't have to invest any more of my precious time because I've got so much happening in my life that I'm not going to invest any time in learning about investing. But I think we all need to. If we're going to catch up to the men in terms of financial success, we need to be prepared to invest a little bit of our time and energy in learning just the basics, at least, about investing. For many women, the idea of investing is too big, too hard, it's too unimportant given all the other things that are going on in our lives. But we've got to start somewhere and commit a little bit of time. You don't even have to prepare on your own. There are plenty of people out there who can help you and at least start you on the path. In terms of preparedness, some of it is actually beyond just how we spend our time. Some of it's about our own money attitudes, and they're not even conscious a lot of the time. It's just sort of how we've been brought up and some of the messages that we receive through our life. And look, some of you might recognise some of these messages that are sort of drilled into us from our parents and our friends and people we hang with. Now, some of these are okay, but some of them can act as barriers because we think, oh, I can't be rich. Rich people, wealth is not something that sits naturally with me or my family. So sometimes these subconscious ideas just stop us from taking the first step to being successful investors. Other myths and misunderstandings, or there's some more actually, there's heaps of them, and I've honestly heard a lot of these from women over the years. But other myths, common myths that I've stumbled across over the years are things like, I need a lot more money before I could start investing. You can start investing with $500, or you can start investing with $100 a month. So you don't need to be super wealthy to start investing. My partner can sort out my finances for me. Yes, I do still hear that. I don't like risk, so I should stick with the bank. All of these are myths, and we really need to put them to bed. The first one, the bank is best. Look, I know it's tempting and to feel safe, and it sort of plays on our risk aversion to just say, look, I'm going to leave my money in the bank because it's safe. Yes, it's safe, but it's not going to keep up with inflation. And even if we've only got low inflation of 2 or 3%, if you don't have any capital growth, then you're not going to keep up with inflation. And so the purchasing power of your investments is just going to diminish over time. So while the bank is good for some things, and absolutely for your rainy day money that you absolutely cannot under any circumstances afford to lose, but otherwise you've got to find some capital growth somewhere in your portfolio, particularly because as women we're going to live longer and we need our money to outlast us. The second myth, what about you can lose everything? Well, yes, you can lose everything, but only if you make really, really bad decisions. I've met thousands of investors who have lost a lot of money by buying one particular investment that goes bad. Well, there's a simple answer to that. Don't just buy one investment, buy a number of investments, build a portfolio so that if one goes wrong, you've still got the others to fall back on. It really doesn't need to be any harder than that. The mortgage comes first. A lot of women, and a lot of men actually, believe that they should pay off their mortgage before they even begin to start saving. That's just a nonsense, because for a lot of us, we don't pay off our mortgages until we're in our 40s or 50s, and then we've run out of time to really build a nest egg that we're going to then live off. So you really should do both, and you can afford to do both. Just putting $50 or $100 aside each month while you're paying off your mortgage means that your money can be working for you, and the earlier you start doing that, the harder your money can work and the more time the more time for compounding to take effect. Shares are too hard. Actually, shares are not hard, especially with the women in this room. You're intelligent women, and buying a share is simply buying a stake in a company. So all you've got to do is get your head around, well, do I like the sound of this company? Does this company make sense to me? Does what it produces or what it sells, does that make sense? Do I think it's going to grow? Do I think it's profitable? What's its track record been like? You can learn all of that just by reading about the shares that you buy. So it's not too hard, and actually it's a hell of a lot easier and far less maintenance than buying things like property. Shares are too risky. Yes, shares are risky, there's no doubt about it. But risk can be managed, risk can be mitigated. It's all about diversifying and the investment approach you take. So the biggest risk actually is not taking any risk at all. Talking about risk, we do tend to be risk averse, and we prefer to avoid any possibility of loss, even if that means limiting our future returns. But contrary as it might sound, we need to learn to embrace risk, the right sort of risk and the right amount of risk for each of us, and it will differ for each of us, because without adequate risk, we can't achieve adequate return. Now, the notion of risk, I think, becomes easier once we visualise it, once we actually boil it down to what risk is. You've got the risk of losing all of your money, but actually that's a relatively small risk because you can diversify away that risk. So what is risk? Well, it's the risk that that the value of your investment will fall temporarily. So if you start visualising, well, how much risk can I tolerate? Could I live with losing 5% or 10% or 15%? And what does that translate to in dollar terms? Could I live with losing $1,000 or $5,000 or $10,000? And what sort of time frame could I tolerate losing it for? Would it be okay if I lost some money, lost some value for a year or 2 years or 5 years or 10 years? Once you start to visualise, once you sort of put numbers on it and you think, well, could I afford to lose maybe $5,000 if I was pretty sure I could get it back after 5 years? If you thought like that, then maybe you'd be prepared to make an investment now, especially if you're younger, because you know you've got a long time frame in which to recover. So rather than just thinking of risk as a scary thing that's stopping you from actually investing, if you try and visualise it and quantify it, it might make it a little bit easier. Warren Buffett said risk comes from not knowing what you're doing. So one of the key ways of overcoming the fear of risk is to just work with somebody who does know what they're doing, so that you don't have to wear it all on your shoulders, and we as women tend to do that. Confidence. Look, a recent US survey found that only 27% of women, compared to 48% of men, said they feel financially confident, and I suspect it's a similar sort of ratio here. It's not altogether surprising, because as women we're not really conditioned to be financially confident. Yes, sometimes we're given responsibility, or we take responsibility for running the household budget, but that's slightly different than actually investing for our family's future. But confidence can come with experience, and look, I can honestly say that every time I make a successful investment, I become more confident in my ability to make successful investments in the future. But if you don't try, you're never going to build that confidence. I think that I like this quote here because it's, you've got to have the confidence to actually take that risk, to take that first step. And yeah, look, it's scary when you first do it, but when you break through, when you push through those doubts and those concerns, it's amazing what can ensue. For me, I have a lot of confidence because over the years, look, I've made great investments, and I've made some real duds as well. We all make mistakes, but each of these investments, and this is just a small sample, each of those has given me confidence that, look, I can find successful investments, and I can get decent sort of returns that mean that my investment's going to grow over time, and I don't just have to rely on paltry bank returns. So the more you invest, the more confident you'll become. But if you don't start, you won't. Time frame. I think the time frame is important. When asked to prioritise the aspects of our lives, I think as women we often put everybody else first before ourselves. We worry about our family and our family's future and education and so on. And then eventually, later in our lives, we think, right, now it's time for me. And that's when you start thinking about investing. The problem is it's often sort of too late, really. If you're starting to think about investing at 45 or 50 or 55, you've really got a really short period of time in which your capital can really work for you. Whereas if you started at 30, even if you started small, the benefit of time is just phenomenal. You all understand the concept of compounding. So you earn interest on your first year's deposit, and then the next year you've got a higher starting balance because of the interest you've earned the year before, and then the next year it's even more, and it grows on itself. So money begets money, but you need to allow time for that to happen. It would be okay. It would be okay if as women we put everything off. It would be okay if we had all the time in the world, but we actually don't. Even though we're going to live longer than our men, we don't want to be wasting those last 7 years sort of worrying about how we're going to pay for the remaining 7 years. So the earlier we can start, the better. Peter Lynch, who's an investment guru, said, look, nobody can predict what's going to happen over the next year or two, and we shouldn't even try. But absent a lot of surprises, stocks are reasonably predictable over 20 years. So if you invest with a 20-year time frame in mind, you're less likely to worry about it, you're less likely to make mistakes than if you're trying to maximise your investment over the next year or two. I just want to tell you a little story about, just to illustrate, I guess, the virtue of patience. Main Freight is one of my favourite all-time companies. I've made a lot of money out of Main Freight, but it hasn't been a straightforward journey. If you look at this period between, it was 98 and 2001, the company expanded into Australia and really, really struggled. And look, I lost patience with Main Freight, and after the first dip, it was taking a long time to recover, and I just thought, look, I'll leave the stock. So I sold out and kept talking to the company and considered buying back in. And this was over 4 years where the stock price had fallen 30%. It was a really hard story. Even though I loved everything the company was doing, I loved the management team. Anyway, the company did convince me to buy back in because they convinced me that they had sorted their problems in the US. And I think this chart just puts it in perspective. You know, that 4 year period where it was really hard to hang on in there because the share price was falling. Look, I've subsequently made 400% afterwards because those problems over 4 years were nothing in the scheme of things. And I guess that's how I like investors to think about their investing lifetime as well. 4 years is nothing in the scheme of things. 5 years is nothing in the scheme of things. Whereas if you look at the returns that you can make over a 30, 40-year period, when your money's working for you, it can far outweigh any short-term difficult times. Communication, look, we don't need to really talk about communication, but communication, we are good at talking. As women, we are really good at talking, but not, it seems, when it comes to money. We will talk about our partners, we will talk about our jobs, we'll talk about our homes, but it's very rare for women to sit down and talk about their savings and their investments and what they're doing to prepare for their retirement lifestyle and financially. We've got to start talking, and we've got to talk to our children, we've got to talk to our daughters, we've got to talk more openly. As an industry, one of my biggest bugbears, I guess, is that our industry tends to talk in jargon and it tends to talk male. I've had so many comments over the years about our newsletter, and people say, we send out a monthly newsletter, and it's deliberately in plain English, and I try and write it as if I'm writing it for my daughter, my 14-year-old. And so many investors say, oh, I just love your newsletter. And because it's so very different from most others in the industry, because I think our industry assumes that it's a male audience predominantly, and so they talk jargon and facts and figures, rather than appealing to the emotions that are also required when you're investing. So look, as an industry we've got to get better, but as women we've also got to get better in terms of communicating. Forgiveness. Another one of those differences between men and women is that is the way we respond to losses and mistakes. As women, we tend to blame ourselves. If we make a mistake, we kick ourselves and we think, oh, if only I hadn't done that, if only I'd asked more people, if only I'd sought advice, and so on. Men don't do that. They will blame the share broker, they will blame the markets, they will blame their accountant, they will blame anybody other than themselves. It can't possibly be that I made a bad investment decision. Whereas women will say, oh, it's all our fault. We've actually got to learn to forgive ourselves and move on, because we all make mistakes and we will continue to make mistakes. This chart here shows that in every single year, since we've been going basically, there have been some stocks that are mistakes. They cost us in terms of our investment returns. But in spite of having stocks every year that hurt us, we've still been able to beat the market in all but 5 years out of the last 16. So we will make mistakes, but we've got to learn to accept them and move on and learn from them so that we don't repeat them again. Look, as a minimum, you knew that I couldn't talk about financial matters without talking KiwiSaver. And look, if we do nothing else, we've got to get this right. KiwiSaver has become the preferred savings vehicle in New Zealand, and rightly so. Even with all the constant changes and tinkering that the government has fiddled with KiwiSaver, it's still a very attractive investment vehicle because it features 3 parties contributing to your savings. So yourself, your employer and the government. And no other investment in New Zealand has 3 parties contributing that way. It's flexible. It forces you to save regardless of what the markets are doing, so it takes away that fear and greed, those emotions that can stop you from making the right decisions. And I suppose because you're investing regularly through KiwiSaver, it's almost forcing you to learn as you earn, because when markets are falling, in fact, the best, KiwiSaver was launched in 2008 and that was the best time possible because that was just after the global financial crisis. So people were forced to contribute to KiwiSaver even as prices were falling. Well, what ended up happening is that they're buying more and more units in KiwiSaver as the prices fall, and then when they rebounded in March 2009, people got an outsized benefit because they've been buying more units while markets were falling. Now, if left to their own devices, probably a lot of those KiwiSaver members would not have been buying as the markets were falling through 2008. So it has become a forced saving for a lot of people, but they've also learned about the value of buying even in falling or volatile markets. KiwiSaver it just makes sense for all investors, everybody under the age of 65, regardless of whether you're employed or self-employed or not employed. And I suppose just one final point on KiwiSaver, don't be tempted to, and women especially, don't be tempted to choose a conservative strategy because you think that's low risk. The younger you are, the more growth assets you should have. So if you have a selection, and everybody in KiwiSaver will, because all KiwiSaver providers allow you the choice of conservative or balanced or growth or something in between. The younger you are, the more you should have in growth. The older you are, as you get closer to 65, the more you should have in conservative. But nobody in this room should have conservative, even though it might feel safer. You need your KiwiSaver to be working for you for as long as it possibly can, and it will work hardest if it's invested in growth assets rather than conservative assets. So look, I encourage you to give it a go. Now, I've talked about share market investing only because that's my gig, but you do need to be investing in growth assets. There are only 2 forms of growth assets, shares and property. So I do encourage you to at least consider it. You can start small, as I said, and you can start by using a fund manager, and that's often a first easy step. So you start with your $100 a month or your $1,000, put it into a managed fund that invests in shares. You can learn a little bit about what that managed fund has got, how many investments it's spread across, and then as you become more confident and more familiar, then you might even try venturing out and buying some shares on your own, something that interests you, a company that you think you can get your head around. And once you've started to have some successful experiences in terms of investment return, you'll be surprised at how confident then you then feel to then venture further and really start to build your investment portfolio. Each of us has got to have some shares in our portfolio. You need to have some capital growth, particularly in this low growth, low inflation environment that we seem set to have for the next 5 or so years. At a minimum, create a plan, start with some objectives, and then start saving, pay yourself first, so look after yourself rather than your family and your friends and so on. Look after yourself because you need it for longer than everyone else. If you haven't joined KiwiSaver, and I'd be surprised if anyone in the room hasn't, but do, and do check your fund. If you're in a conservative fund, just have another look. Take the time to learn a little bit, reduce your debt, ask for help, talk about money to women and to men, take some risks, and don't think about everyone else. So that's it, and I would love to answer any questions.
Thanks, Carmel. Questions for Carmel?
We must have some questions, I'm sure.
Down the back.
We've got one here.
Thank you very much, Carmel. I work in the financial services industry as well, and can relate to what you were saying earlier about often doing presentations and it's a room full of men. And we were talking about obviously ways to advance women in law partnerships earlier. What suggestions have you got for increasing women in financial services and seeing more female financial advisors?
Sure, look, I would love to have suggestions, but it's been a bugbear for me for years, and I find it so frustrating. We will advertise for roles, and I'll tell recruitment agencies, I know you're not supposed to, but I'll say I'd really like a woman, and just nobody applies. It's sort of, for a lot of women, I think they see accounting as sort of the safer bet. So anyone who likes money or likes numbers, likes financial services, will typically veer towards banking or accounting rather than in I suppose, pure finance. I think an investment analyst is just an ideal role for women because we are analytical. We like to ask questions. We like to talk to people. We like to really get to the guts of what makes a company or a chief executive tick. And yet very, very few women apply for roles as investment analysts. So I don't know what it is. I guess I try wherever possible to tell my story because it's been an absolute blast. I've absolutely loved my career. I love what I do. And I love the fact that I've become a successful investor, not because I'm brainy or because I'm great at maths, quite the contrary. And so I've spoken at one seminar with Mainfreight, the chief executive of Mainfreight, and he was asked, why do you think Carmel was able to pick your company? And because we picked Mainfreight, a lot of people have picked Mainfreight as a successful investment, but we just happened to have a whole lot of it. And so therefore, when it performed well, we got an outsized benefit. And so Don was asked, what do you think made Carmel a good analyst? And he said, look, she just came and sat with a notepad and she asked for my story and wrote down all the company's objectives and so on. And she came into the tea room and just loved the fact that, the management shared the tea room with the staff and all the rest of it. So they were sort of almost the touchy-feely things, whereas a lot of male analysts will sit there and they'll go through the balance sheet and they'll get the facts and the figures without actually understanding what makes the company tick and what would make this company so successful that it would double in size over a 5-year period. It's the gut feeling, it's the questions that women are more likely to be interested in the answers to than men should make us great investors. So there should be lots of female fund managers. There are overseas, there just aren't here. There's 2 of us. And there should be more investment analysts. Now, in my early career, there were more women as analysts, but they typically worked for investment banks and share brokers, and those firms worked them like to the bone. If a company came out with a profit result, those analysts would have to work until 3 or 4 in the morning to analyse that profit result and say whether it was a buy, sell or a hold, and then they'd get home at 3. Well, nobody needs to live like that. So that's probably put women off. I don't know whether it's changed actually over the years, but I don't know how to get more women in. I just think I've got to tell more and more women that it's a great business to be in. So tell your friends.
If you want to retire fairly soon, you don't have a long time to invest your money. What's the difference between going fund or going property?
Look, I don't. They'll both work for you. They're both property and a fund. So you said property or a fund? Yes. Yeah, so shares or a fund, basically, or shares or property. They are both growth assets. The only question marks I have, some would say that property is now overvalued, but then people would equally say that shares are overvalued because they've had such a good rally for sort of 5 years. I think with shares, I've always found it appealing that they're quite liquid, so you can buy or sell whenever. And so if your circumstances change, you can sell a share portfolio. You can't as readily sell a property. And also, property values generally need good inflation. They either need good immigration, so you've got a big demand pipe, or they need inflation. We're not going to have inflation for a long time, whereas companies don't need inflation in order to grow their profits. So if you buy shares in companies that have a strong competitive advantage, they've had a history of growing their profits, then it's somewhat easier, I think, to make a bet or make the argument that shares will perform irrespective of what the economic environment's going to be for the next 5 years, whereas property needs a few things to keep going right. We need immigration, we need people to keep wanting to come and buy our property, and we need inflation, and those two are not givens, whereas company earnings, if you choose the right companies, company earnings should be a given. So I would always prefer shares, but I am slightly biased.
Other questions?
I'm just wondering if there's any strategies that you would recommend for successful marketing in a male-dominated industry, or successful networking.
I think that's an interesting question. Marketing and networking. Women are typically really, really good at networking. I hate networking. I'm the sort of person, if I went into a room, if I didn't know somebody, doesn't matter how confident I am in myself, I'd probably just turn around and go out. I just don't like going up to a group of people, even if they're women and they're not scary like men. I don't like that sort of thing. And so I've been to so many networking groups and clubs and things, and I know that you're supposed to get some real career benefit and stuff out of networking, but I've not experienced that. In terms of marketing, I've found since I've started Fisher Funds, the best form of marketing for me has been turning our clients into advocates, basically. So self-promotion. There is a reason we're called Fisher Funds, and that's named after me, and that my image is on all the documentation. Very few other fund managers do that. They would rather stand behind a big brand and sort of navy blue, because that's supposed to be a good colour for professional services, all that sort of stuff. Whereas I've always found that people who are entrusting their money with me, they want to know the people behind it, and they want to hear you speak, and they want to know that you're also invested in the funds, and so you're aligned with them. So the more self-promotion I've done, the more I've sort of put myself in front of investors and potential investors, the more helpful that's been. And so our brand has been built largely by referral from existing clients. So we still have around 45% of our new business comes from referrals from our existing clients. That's more successful to us than any marketing campaigns that we've done. We've done clever marketing campaigns in the past, but they tend to be short-lived. And unless they're absolutely consistent with your brand values and so on, it's really hard to convey some of your brand value. Like for us, it's sort of we want people to know that we're real and that we speak their language, and that we're not scary, and we're there to hold their hand, and all those sorts of things. How do you convey that through marketing? So look, I think self-promotion, without being smart or without being too over the top, but I think we all relate to people one at a time, and if someone's going to support your business or support you, it will be because they like you and they get you. So if that means you've just got to engage with as many people one at a time, if that takes you years, so be it. But if you do it well at the outset, then those clients are with you for a long time, and they become your advocates, and then it has a networking effect, but it's not you doing the networking, it's other people doing it on your behalf. So.
Any other questions? No, well, if it's not, then I can thank you.
Thank you.